Alright guys, welcome back for another video. In today's video I want to talk about the topic of the bullwhip effect. You guys may have heard Michael Burry talking about this on Twitter, but essentially the bullwhip effect is when major companies and corporations like Target, Walmart, these general basic home goods stores create excess inventory, and that excess inventory creates excess supply, and if demand remains constant, then the prices of those goods will fall because supply has risen. And this is something Michael Burry has pointed out on Twitter, and it's one of his rationales for why CPI he believes has peaked and won't necessarily go down in real terms, but the rate of change will have peaked, and we'll see that rate of change decline. There's a lot of different reasons why a company would inflate its inventory, either in real terms or inflate it on its balance sheet to give different illusions of profitability. We'll go into that in this video. I'll also talk about other items on the balance sheet and kind of revisit that bullwhip topic at the end of the video. So ultimately, we know that credit decisions are based upon a company's ability to repay debt. And a company's ability to repay is a function of its ability to generate cash flow in excess of debt. And it's no secret that we live in an extremely inflationary environment, and that it cuts into the margins of the company by influencing their costs of goods sold figure. This is extremely important because the cost of goods sold is generally the greatest single expense category a company faces, and it's the major determinant of profitability. If the cost of goods sold figure is rising in relation to sales, the company may be in a cost-price squeeze. If the cost of raw materials or labor is rising, but the market is resistant to a price increase intended to pass on the rising costs, profits per unit will decrease and cash flow will fall. Because cost of goods sold is a production-related expense, they are matched against revenue at sale. They can be comprised of costs that vary directly with sales volume, with raw materials, with direct manufacturing, with labor, or with direct manufacturing overhead. Raw materials and labor are variable costs, while manufacturing overhead is a semi-fixed cost. And the cost of goods sold is generally adjusted so that it reflects only its variable cost components. This is accomplished by dropping the manufacturing overhead into selling, general, and administrative expenses, even though it may not seem reasonable from an accounting point of view. Selling, general, and administrative expenses are often referred to as SG&A expenses. By dropping out the manufacturing overhead, the cost of goods sold should vary with sales consistently, and it should, as a percentage of sales, remain stable. If the cost of goods sold to sales ratio changes, then something fundamentally is changing in the cost-price relationship of a product. The ability to repay debt is ultimately determined by cash flow. The primary ingredient of cash flow is profits. As the balance sheet provides a snapshot of a company at an instant in time and gives important clues as to the length of a company's credit cycle and its ability to repay debt. The P&L, or also known as profit and loss, the P&L reveals the story of how well the company buys and sells inventory or services to make a profit. Profits are ultimately the determinants of debt capacity. Profits are also the difference between revenues and expenses. When inventory is shipped, revenue is recorded. Also at this time, expenses associated with the production, such as raw materials, direct labor, and sales commission and delivery costs, are charged against the revenue. Other expenses such as rent, the receptionist, office salaries, telephone, are more related to time than to production or selling. These are known as period expenses and are charged against revenue periodically. It's important to compare income statements from different accounting periods, as the changes in revenues, operating costs, research and development spending, and net earnings over time are more meaningful than the numbers themselves. A company's revenues may be growing, but its expenses might be growing at a faster rate. Determining a company's profit and loss, or P&L, starts with analyzing their sales. Sales are usually a net figure of revenue earned through company operations. There's also discretionary, non-cash, and impacted expenses deducted from the overall SG&A figure and drop below the operating profit line for separate analysis. They're generally analyzed relative to sales to make certain that they are not increasing as sales rise. As a company grows, the fixed cost per unit of production should be decreasing. Operating profit is profit remaining after these SG&A expenses or selling, general, and administrative expenses are paid, as well as subtracting rent, owner's salary, depreciation, interest expenses, and cost of goods sold is subtracted from sales. Once all the noise of expenses has been cleared away, profits are what remain. Discretionary, non-cash, and impacted expenses are the expenses that either exist at the discretion of the principals, meaning owner's salary, depreciation, and non-cash paper expenses, depreciation, and that can be added back to profits after tax or are impacted by the project that the borrower is seeking financing for, whether for the refinancing of high-cost debt or changes in occupancy, meaning changes in renting or buying of the place of business operation. These expenses are deducted from the reported SG&A. The SG&A total is adjusted downward to prevent double counting of the discretionary expenses. They are analyzed to determine how they impact debt capacity and how they will react if a loan for the proposed project is made. Stable earnings before tax shows that a company is managing its margins and overhead well. It can be affected by one-time expenses and discretionary expenses. Earnings before tax is calculated by subtracting discretionary expenses from operating profit. How a company is legally organized and the availability of federal and state tax credits determine a company's annual income tax liability. Most small businesses are organized as partnerships, sole proprietorships, S corporations, and single-member limited liability companies. Each of these forms are pass-through entities where taxes are paid by the owners through their individual, not corporate tax returns. A C corporation under the U.S. federal income tax law refers to any corporation that is taxed separately from its owners. The Tax Cut and Jobs Act of 2017 made some pretty clear major changes to individual and corporate tax rates. Under the Act, brackets were eliminated for C corporations, and a flat rate of 21% on all earnings was applied. Individual tax rates for single and married filers range from roughly 10% to a maximum of 37%. But there are some provisions under the Act that allowed pass-through entities to deduct up to 20% of qualified business income, reducing their federal income tax liability. Profit after tax is essentially the profit that remains after income taxes are subtracted from the earnings before tax figure. This can determine if earnings are available for distribution or reinvestment in the company. Entrepreneurs really have three primary ways to keep these earnings before tax low to postpone taxes. And going back to what we were saying about the bullwhip effect, they can create an inventory cushion by buying excess storable supplies. It's a combined effect of keeping earnings before taxes low and also hedging yourself against future base commodity cost price inflation in the future. So it's a double effect there. And by undercounting the ending inventory, this is in the opposite direction, but by undercounting the ending inventory, a company can overstate the cost of goods sold and reduce the earnings before taxes. Now, today's ending inventory is essentially tomorrow's beginning inventory, and a permanent and increasing inventory cushion is really difficult to maintain because inventory would essentially become less every year. Inventory cushions tend to be liquidated in low profit periods when tax liabilities are low. If a company is building an inventory cushion, the cost of goods sold will be overstated, and the ratio of costs of goods sold to sales will begin to rise. This can give the appearance of a decreasing profit margin despite the company actually being profitable. And it can also help them take the advantage of accelerated depreciation or expensing and allow them to offer increased compensation. But really, I think the fundamental thing here is that these inventory cushions basically they're done where period of tax liabilities are high and stock up in the intent to liquidate them when tax liabilities are lower. But really, I think the important thing here is that they give the appearance of a decreasing profit margin even when the company is being profitable. So, how many of, if we have this bullwhip effect occurring among these like major companies, I think it's a big reason why you see a lot of the earning reports come in so low. It's just these companies are actually more profitable than they appear to be on their earnings reports because of these inventory cushions. And, ultimately, I think that is something that will unwind in the future. And I also think it's, these inventory cushions they need to be liquidated at some point. And when they are liquidated, especially for these major corporations like Walmart, Target, these companies, Procter & Gamble, that provide the base goods and services that people need to survive, once they start unloading that supply, demand remains constant, then the prices of those goods should fall. Even if they're still relatively elevated, I think, we'll see that rate of change in CPI peak, and at least, decline in relative terms, while still being elevated in objective terms. Now, of course, there's a myriad of factors affecting prices, right? There are literally thousands of factors. But I do think this is, a pretty relevant factor, and I did want to take the time to do a deep dive on it and do a video on it. So I hope you guys found some value out of this. And, of course, if you did, just leave a like on the video, subscribe to the channel, and I'll catch you guys in the next upload.